Hey everyone, welcome back to the channel. Today, we re-tackling a question that a lot of you have asked. What is the difference between mutual funds and treasury bills? It sounds complicated, but I promise, by the end of this video, you'll know exactly which one might be right for you. So, let's demystify these two popular investment options together. First up, what exactly are they? Think of a mutual fund as a big pot of money where lots of people, just like you and me, pool their cash together. A professional fund manager then takes that money and invests it in a mix of assets like stocks, bonds, or other securities. It's like hiring a chef to cook a diversified meal for you. On the other hand, we have treasury bills, or T-bills. These are short-term loans you give to the government. The government issues them to raise money and promises to pay you back in a short period, usually less than a year. It is considered one of the safest investments on the planet because it is backed by the full faith and credit of the government. Now let's talk risk, because this is a huge differentiator. The risk of a mutual fund really depends on what it invests in. An equity fund that buys stocks will be much riskier than a money market fund that holds safer, short-term debt. So, with mutual funds, the risk can range from low to high. T-bills, however, are on the complete opposite end of the spectrum. Their risk is extremely low. The chance of the government not paying you back is practically zero, which is why they're often called risk-free assets. So, with lower risk, you probably expect lower returns, right? Exactly. T-bills offer predictable, but generally lower, returns. You know what you're going to get. Mutual funds, especially those invested in stocks, have the potential for much higher returns over the long run. But, and this is a big but, those returns are not guaranteed. The value of your investment can go up, but it can also go down. You get paid through dividends, interest, and capital gains when the fund's assets increase in value. With T-bills, your earnings come from buying the bill at a discount to its face value and getting the full face value back at maturity. For example, you might pay $990 for a $1,000 T-bill and get that full $1,000 back when it matures. What about how long you should invest? Mutual funds are typically best for medium to long-term goals. Think saving for retirement or a down payment on a house in 5 or 10 years. The longer time horizon gives your investment a chance to grow and ride out any market bumps. T-bills are perfect for the short term. They're great for parking cash you'll need soon, like for an emergency fund or a big purchase you plan to make in the next year. It keeps your money safe and earns a little bit of interest. Let's discuss liquidity, or how easily you can get your cash back. Mutual funds are generally very liquid. You can sell your shares on any business day and get your money, though the price you get depends on the market value that day. T-bills are meant to be held until they mature. While you can sell them on a secondary market before maturity, it's not as straightforward as selling a mutual fund. Another key point is inflation. Over time, inflation erodes the purchasing power of your money. Equity-based mutual funds have a good track record of beating inflation over the long term because company earnings and stock prices tend to grow faster than inflation. T-bills, with their lower returns, might struggle to keep pace, meaning your money could actually lose purchasing power during periods of high inflation. So, who should invest in which? If you're looking for long-term growth, want to diversify your investments without picking individual stocks, and are comfortable with some market risk, a mutual fund could be a great fit. They're also very accessible, with many funds having low minimum investment amounts, making them perfect for beginners. If your top priority is keeping your capital safe and you need a place to park your cash for the short term, T-bills are an excellent choice. They are favored by conservative investors who can't afford to lose their principal. However, T-bills often require a higher minimum investment, so that's something to keep in mind. To sum it all up, mutual funds are your go-to for long-term wealth building, offering professional management and diversification with variable risk. T-bills are your fortress of safety for short-term goals, providing security and predictable, though modest, returns. One is about growth potential, the other is about capital preservation. Choosing between them really comes down to your personal financial goals, your time horizon, and your tolerance for risk. I hope this breakdown was helpful. If you learned something new today, make sure to hit that like button and subscribe for more content just like this. Got any questions? Drop them in the comments below. Thanks for watching, and I'll see you in the next video.